Welcome to the deep dive. We're about to jump into a wealth of information you've given us, specifically on the essential building blocks of personal finance.
That's right. Think of this as your guided tour through some really, really important concepts. How to save for retirement, understand investments, fund education, protect yourself with insurance, figure out your real returns after tax, and even get the basics of estate planning.
Yeah, our goal isn't to, bury you in every single detail. We want to zero in on the most important nuggets of knowledge and insight from this material, help you understand the key rules, the advantages, the potential pitfalls.
And crucially, why it all matters to you.
Exactly.
So let's get straight into it, building that financial future, starting with retirement planning and these powerful things called qualified retirement plans.
Qualified retirement plans, okay.
Oh,
The sources highlight these as offering some pretty significant advantages. Depending on the specific type, we're talking potential benefits like contributions made before income tax is taken out, or contributions that are actually tax deductible.
and maybe the biggest one. They all offer tax-deferred accumulation of earnings. This is incredibly powerful, especially over the long term.
Right.
I mean, imagine your investments growing year after year, compounding not just on what you put in, but also on the earnings that haven't been taxed yet. That money stays in the account working for you.
Instead of, a chunk going to taxes every year.
Precisely. It just keeps building.
That compounding effect over decades is just massive.
Yeah.
Plus, the sources mention some other benefits maybe people don't think about as much, like asset protection from creditors.
Yeah, that's a really significant layer of security for many people. And when they're structured the right way, often involving trusts or certain insurance setups, these assets can potentially avoid the whole probate process.
Probate. That formal, often kind of slow and potentially expensive legal process for sorting out an estate after someone passes. Avoiding that means assets get to your beneficiaries faster
Right.
and more efficiently.
Exactly. But like most things in finance, there are trade-offs. The sources are clear. While you get these tax advantages maybe upfront and during the growth phase, the income is typically taxed later on when you take it out as ordinary income.
Which that rate can be higher than, say, the long-term capital gains rate you might get if you sold investments in a regular non-retirement brokerage account.
That's a key point. And generally, these accounts aren't meant for easy access before retirement. There are penalties if you take money out too early.
Though there are exceptions.
Yes, the material we have lists some very specific exceptions where that early withdrawal penalty might be waived. We'll get into those.
Okay, so big picture. Tax advantages now and during growth, but taxes later, usually as ordinary income, and it's not really liquid money. The sources mention four main categories here: employer-sponsored 401ks,
Yep.
traditional IRAs, Roth IRAs, and annuity contracts.
Let's start with the employer plans. They seem to fall into two main camps, right? Defined benefit and defined contribution.
Defined benefit plans. That sounds like the old school pension plans like my grandparents had.
That's exactly what they are. With a defined benefit plan, the employer basically makes a promise. They tell you, okay, you'll get a specific, predictable monthly benefit when you hit retirement age. And that benefit is often based on some format, your salary, how long you work there, maybe your age.
So the employee knows what they're aiming for. Who's managing the money behind that promise?
The employer sponsors it and manages the investments, often hiring professional managers to do it. And here's the really crucial insight about these defined benefit plans. The employer bears the investment risk.
All of it.
Yes. If the plan's investments don't perform well enough to cover all the promised benefits down the road, the company has to use its own earnings to make up the difference. The employee's promised benefit isn't supposed to change based on market swings, at least from their perspective.
Okay, that explains why they've become less common then. That's a huge risk for companies to carry.
Right.
So defined contribution plans must be different.
Very different. Here, there's no promise of a specific benefit amount when you retire. Instead, you, or maybe your employer, or both, contribute defined amounts into an individual account set up just for you.
And the investment risk.
Flips completely. In a defined contribution plan, you, the employee, you bear the investment risk. The value of your retirement account goes up and down with the market. What you end up with at retirement is simply whatever's in that account. Your contributions plus or minus any investment gains or losses over the years.
And the most common example of this is the 401k. which our material covers in quite a bit of detail.
Yes, the 401k. It's really the workhorse for many people's retirement savings these days. Employees contribute a part of their salary or wages, and a huge advantage, which the material definitely highlights, is that employer matching contribution.
That's the free money part, right?
Essentially, yes.
Yeah.
Contributing enough to get the full match is like step one for maximizing your savings. It's often recommended as the very first thing to aim for.
It's like getting an immediate guaranteed return just from the match itself. Now, the tax treatment of a 401k, that depends on whether it's a traditional 401k or a Roth 401k.
Exactly. And there are limits on how much you can put in. For 2023, the material lays out the contribution limits. The maximum you, as an employee, could choose to defer from your paycheck was $22,500. Or if you were age 50 or older, you could put in an extra catch-up amount, making it $30,000. And this is also capped by your total compensation, of course.
And that $22,500 or $30,000, that's just your contribution. There's a higher overall limit for the total combined contributions from both you and your employer, right?
Yes, there is. For 2023, that total limit employee plus employer contributions combined was $66,000. Or, again, if you were 50 or older, it was $73,500.
Okay, let's dig into the tax implications of those contributions. Traditional versus Roth.
Okay, so with a traditional 401k, the money you contribute comes out of your paycheck before federal and state income taxes are calculated. So you get an upfront tax break on that income. You still pay FICA and FUTA taxes, Social Security and Medicare, unemployment on it, though.
Pay less income tax now. Got it. What about a Roth 401k?
With a Roth 401k, it's the opposite upfront. The wages you contribute are included in your taxable income for that year. You pay the income tax on that money right away. The benefit comes later.
And the employer match, how is that treated tax-wise?
This is an interesting detail from the material. When your employer contributes matching funds to your traditional 401k, that match amount is not considered taxable income to you in the year they contribute it. It grows tax deferred along with your contributions.
Okay.
However, if your plan allows employer contributions to be designated as Roth contributions, and not all plans do this, then those employer Roth contributions are considered taxable income to you in the year they are made.
Huh. That's a key difference. So you could end up paying tax on the match now if it goes into the Roth side versus deferring it if it goes into the traditional side.
Exactly. Something to be aware of depending on your plan specifics.
Now let's fast forward to retirement. Taking money out. How are those distributions taxed?
All right. Distributions from a traditional 401k, all that money that went in pre-tax, plus all the earnings are generally fully taxable as ordinary income when you withdraw them in retirement.
So the whole withdrawal gets taxed. What about the Roth 401k?
This is where the big payoff for paying taxes upfront comes, assuming it's what's called a qualified distribution. Your original contributions, the money you already paid tax on, come out completely tax-free. They're never taxed again.
Okay.
And the earnings portion of the distribution is only taxable if the distribution is non-qualified. If it's qualified, the earnings are tax-free too.
So the whole withdrawal can be tax-free. What makes a Roth 401k distribution qualified then?
The material specifies two main requirements you generally have to meet. First, you have to be at least age 59 and a half. Second, the Roth 401k account must have been established for at least 5 years.
5 years from.
That 5-year clock starts ticking from the first day of the calendar year in which you made your very first contribution to any Roth 401k plan sponsored by that employer.
Yeah. So if you take money out before you meet both of those conditions, age 59 and a half A and D, the 5-year rule, it's considered non-qualified.
Yes. And if it's non-qualified, the material explains how it's taxed. The amount you withdraw is allocated pro rata proportionally between your contributions, the principal, and the earnings in the account, based on their respective values at the time you take the money out.
Okay.
The principal portion, your contributions, still comes out tax-free because you already paid tax on it, but the earnings portion of that non-qualified withdrawal is taxed as ordinary income and potentially subject to penalty, which we'll get to.
Right, the penalty. On top of any income tax owed, there's usually a penalty for taking money out of a 401k too early.
That's the general rule, yes. A 10% additional penalty tax is applied to the taxable portion of any distribution taken before you reach age 59 and a half.
But you mentioned an exception for 401ks specifically.
Yes, a key one for employer plans like 401k. If you leave your job with that employer separate from service, is the term in the year you turn age 55 or later, the 10% penalty does not apply to distributions you take from that employer's 401k, even if you're not yet 59 and a half.
Ah, the rule of 55. That's important. Are there other specific situations where the penalty might be waived?
Yes, the material lists several others. For example, if you use the distribution to pay for medical expenses that exceed a certain percentage of your adjusted gross income, AGI, or up to $5,000 taken shortly after a qualified birth or adoption, if you become totally and permanently disabled, if distributions are made because of a divorce decree, what's called a Qualified Domestic Relations Order, or QDRO. Upon your death, distributions to your beneficiary aren't penalized, or if you're terminally ill. And there's an exception for up to $22,000 for certain federally declared natural disasters.
So quite a few specific circumstances. It's good to know those exist. The list is a bit different for IRAs though, right?
Yes, we'll see. The IRA list is slightly different when we get there. It's important to track which exceptions apply to which type of account.
Okay. Let's say you leave your job, maybe before retirement age, and you get a lump sum payout option from your 401k. What's the best way to handle that to avoid immediate income taxes and that 10% penalty?
The safest route is typically a direct rollover. That's where the money goes straight from your old 401k provider to another qualified retirement plan, like an IRA or maybe your new employer's 401k, without you ever touching it. This avoids the 60-day rule and potential mandatory tax withholding.
What's the 60-day rule?
If you instead receive the check yourself, you generally have 60 days to deposit it into another qualified plan. If you miss that deadline, it's typically treated as a taxable distribution, and if you're under 59 and a half, the 10% penalty applies. Plus, if you get the check directly, the employer usually has to withhold 20% for potential federal income tax. You'd only get 80% of your money and would need to come up with the other 20% out of pocket to roll over the full amount within 60 days to avoid taxation on that withheld portion. Direct rollovers avoid all that hassle.
So direct rollover is usually the way to go. And remember that age 55 separation from service rule applies to the penalty here too, but you still owe income tax unless you roll it over.
Correct. The age 55 rule avoids the penalty, but not the income tax if you just take the cash. The rollover avoids both.
Okay. And eventually the government wants you to start taking money out of these tax-deferred accounts, right?
Yeah.
Required minimum distributions, or RMDs.
Yes. Uncle Sam wants his tax revenue eventually. For 401ks, the material states that RMDs generally must begin by April 1st of the year after the year in which you reach age 73. However, there's a key exception. If you are still working for the employer who sponsors the 401k plan and you don't own more than 5% of the company, you can delay taking RMDs from that specific plan until April 1st of the year after you actually retire from that job, even if that's later than age 73.
Okay. So it's the later of age 73 or retirement for the plan you're still working at. What happens if you miss taking an RMD on time?
The penalty is pretty harsh. It's 25% of the amount you should have withdrawn but didn't. Ouch.
Yeah, that's steep.
The material does note that this penalty can potentially be reduced to 10% if you realize the mistake, take the RMD, pay the tax, and file the appropriate form with the IRS relatively quickly. But it's definitely something you want to avoid altogether.
Absolutely. Okay, that was a really thorough look at 401ks. Let's shift gears to individual retirement accounts, or IRAs. The sources describe these as long-term tax advantage savings accounts for individuals not tied to an employer and funded with earned income.
Right. These are accounts you set up yourself. The earnings inside grow tax-deferred, just like in a 401k. And depending on the type of IRA and your income situation, your contributions might be tax-deductible.
What are the contribution limits for IRAs? Are they the same as 401ks?
No, they're much lower. For 2023, the maximum amount you could contribute annually was the lesser of a specific dollar limit or your total earned income for the year.
Okay, and those dollar limits?
For 2023, if you were under age 50, the limit was $6,500. If you were age 50 or older, you could add a $1,000 catch-up contribution, bringing the limit to $7,500.
And that $6,500 or $7,500 limit, that applies to your total contributions combined across all your traditional and Roth IRAs for the year, right? You can't put the max in both.
Exactly. It's a combined limit for the individual.
You mentioned it has to be funded with earned income. What counts as earned income for IRA purposes?
The material clarifies this. It includes things like wages, salaries, tips, commissions, bonuses, and net earnings from self-employment if you own your own business. It also includes taxable alimony received under divorce or separation agreements executed before 2019, and certain taxable fellowship and stipend payments for graduate students.
And what specifically does not count as earned income?
This is important too. It does not include passive income like interest, dividends, income from rental properties usually, annuity income, or pension payments. If you don't have any earned income in a given year, you generally can't contribute to an IRA for that year, even if you have lots of investment income. There's a spousal IRA exception, though.
Okay, now let's talk about the tax deduction for traditional IRA contributions. This seems like where it gets a bit complicated because it's not always fully deductible.
It definitely requires paying close attention to the rules. If you can deduct it, it's an above-the-line deduction, which means it reduces your adjusted gross income, AGI, which is generally good. You have until the tax filing deadline, usually April 15th, to make your IRA contribution for the previous year, no extensions for the contribution itself.
And the big factor determining if you can deduct it or not seems to be whether you or your spouse, if you're married, are also covered by a retirement plan at work, like a 401k.
Precisely. That's the main trigger for the income limitations. Here's the rule from the material. If you are not considered an active participant in an employer-sponsored retirement plan for the year, then your traditional IRA contribution is fully deductible no matter how high your income is.
Simple enough if you don't have a work plan. But what if you do have a work plan?
If you are an active participant in an employer plan, then your ability to deduct your traditional IRA contribution is phased out based on your modified adjusted gross income, MAGI. For 2023, the phase-out range for active participants who were single or head of household was $73,000 to $83,000 MAGI. If your MAGI was below $73K, fully deductible. Above $83K, not deductible at all. In between, it's partially deductible.
And for married couples filing jointly, if either spouse is an active participant.
If you file jointly and you are an active participant, the 2023 phase-out range for your deduction was $116,000 to $136,000 of combined NGI.
But what about the spouse who isn't covered by a work plan? Is their deduction limited too?
Yes, but by a different higher range. This is the special rule you mentioned. If you're married filing jointly and you are not an active participant but your spouse is, your ability to deduct your contribution phases out based on a much higher combined MBI range. $218,000 to $228,000 for 2023.
Wow, okay, so even if you personally don't have a work plan, your spouse having one still imposes an income limit on your deduction, just a higher one.
Exactly. And the material adds a note for those married filing separately. If you lived with your spouse at any time during the year and either of you is an active participant, the phase-out range for the deduction is a very low $0 to $10,000 MAGI. So basically no deduction if you make over $10.
So your filing status, your spouse's work plan status, and your combined income all play a role. The source material provides example 1 with Christy to walk through this.
Right, let's look at Christy. She's 40, single, she is an active participant in her employer's 401k, and her 2023 MAGI is $75,000. Her maximum IRA contribution limit under 50 is $6,500.
Okay, single, active participant, 75K AMI-GI. That falls within that 73K to 83K phase-out range for single active participants.
Correct. So her deduction is partially limited. The material shows the calculation. Her AMGI, $75,000, is $2,000 above the bottom end of the phase-out range, $73,000. The total width of the phase-out range is $10,000, 83K, 73K. So her deduction is reduced by the ratio of how far she is into the range, $2,000, $10,000, 0.20 square, or 20%.
So 20% of her maximum $6,500 contribution is disallowed as a deduction. 20% of $6,500 is $1,300.
Right. So her deductible contribution is limited to $6,500 minus the $1,300 disallowed portion, which equals $5,200. She can still contribute the full $6,500, but only $5,200 is deductible. The other $1,300 would be a non-deductible contribution.
That clearly shows how the phase-out works. The example then asks, what if Christy was not an active participant in a work plan?
In that scenario, the material confirms she could deduct the entire $6,500 contribution. Because she's not an active participant, the MAGI phase-out limits simply don't apply to her deduction.
Makes sense. The work plan participation is the key that unlocks those income limits. Now, shifting to Roth IRA contributions, no deduction when you contribute, right?
Correct. With a Roth, you don't get an upfront deduction. The tax benefit comes later, potentially with tax-free growth and tax-free qualified distributions in retirement.
But your ability to even make a contribution to a Roth IRA is also limited by income, using MBI again, but with different phase-out ranges.
Yes. For 2023, the ability to contribute directly to a Roth IRA phased out for single filers, with MAGI between $138,000 and $153,000. For married couples filing jointly, the phase-out range was $218,000 to $228,000 MAGI. And again, for married filing separately, if you live with your spouse, the range is very low, $0 to $10,000 MAGI. If your MAGI is above the top end of the range for your filing status, you cannot contribute directly to a Roth IRA for that year.
Okay, so different income tests and different limits depending on whether you're trying to deduct a traditional IRA contribution or make a direct Roth IRA contribution. Now, let's talk about taking money out to distributions. How is that money taxed?
Okay, so whether it's a traditional or Roth IRA, when you take a distribution, it's generally considered to be made up of two parts: your principal, the contributions you put in, and the earnings that have accumulated. Any part of the distribution that is taxable is taxed as ordinary income, regardless of whether the underlying investments generated capital gains or dividends. You don't get preferential capital gains rates on IRA distributions.
How do distributions from traditional IRAs work, tax-wise?
It depends on whether you deducted your contributions. If you took a tax deduction for all your contributions over the years, then all distributions, both principal and earnings, are fully taxable as ordinary income.
Simple enough if everything was deductible. But what if you made some non-deductible contributions to your traditional IRA, like Christy in the example, who could only deduct part of hers?
Right. If you have non-deductible contributions in your traditional IRA, you'd track this using IRS Form 8606, then a portion of each distribution is considered a tax-free return of your non-deductible principal. The earnings portion is always taxable.
So how do you figure out the split between the non-taxable principal and the taxable earnings if you have a mix?
The material explains it uses a pro rata rule, similar to the non-qualified Roth 401k withdrawal, but applied differently across all your traditional IRAs. You basically calculate the ratio of your total non-deductible contributions, your basis, to the total value of all your traditional IRAs, including SEP and simple IRAs, at the end of the year, plus distributions taken during the year. That ratio represents the non-taxable percentage of any distribution you took during the year. The rest of the distribution is taxable.
Okay, that sounds like it requires careful record keeping of non-deductible contributions over potentially many years.
Absolutely. Keeping track of Form 8606 is crucial if you make non-deductible traditional IRA contributions.
And traditional IRAs also have RMDs starting at age 73, just like 401k.
Yes, the RMD rules are generally the same for traditional IRAs as for 401ks. They start April 1st of the year after you turn 73.
Now, Roth IRA distributions, you mentioned qualified ones, can be entirely tax-free.
That's the main draw. Distributions of your original contributions, principal, from a Roth IRA are always tax-free because you paid tax on that money going in. They are never taxed again.
Okay.
Distributions of the earnings are tax-free only if the distribution is qualified. If it's non-qualified, the earnings portion is taxable.
And remind us what makes a Roth IRA distribution qualified.
Similar to the Roth 401k, there are two main conditions. First, you need to have met the 5-year holding period. That clock starts on January 1st of the year you made your very first contribution to any Roth IRA. Second, you must meet one of several triggering conditions. You are age 59 and a half or older, or you are disabled, or the distribution is made to your beneficiary after your death, or you use up to $10,000 for a first-time home purchase. Meet the 5-year rule any one of those triggers, and the earnings are tax-free.
But here's where the Roth IRA has a really neat feature, right? The ordering rules for distributions.
Yes, this is a huge advantage highlighted in the material and often misunderstood. When you take money out of a Roth IRA, the IRS considers the withdrawals to come out in a specific order. First, from your regular contributions, principal. Second, from any amounts you converted from traditional accounts, conversion principal. Third, from the earnings on those conversions. And last, from the earnings on your regular contributions.
So what does that mean practically? It means you can pull out your original contributions, the money you put in, directly tax-free and penalty-free at any time for any reason before you even touch the earnings.
Precisely. Because your contributions always come out first and are never taxable, since you paid tax going in, you have much easier access to that principal amount in a Roth IRA compared to a traditional IRA without immediate tax consequences or penalties on that amount. This gives Roth IRAs a level of flexibility that's quite attractive.
That distinction is critical, and the materials example 2 with Sally really drives this home by comparing different scenarios.
Yes, let's walk through Sally's case quickly. She put $5,000 into an IRA at age 55. Later, it's grown to $8,000, so $5,000 principal, $3,000 earnings. She takes a $6,000 withdrawal.
Okay, scenario 1. It was a traditional IRA, and she deducted the $5,000 contribution.
Since she deducted it, the entire $8,000 balance is considered pre-tax. Her $6,000 withdrawal is therefore fully taxable as ordinary income. The material confirms $6,000 taxable.
Scenario 2. Traditional IRA, But she did not deduct the contribution. It was non-deductible.
Now she has $5,000 of basis,
Yes.
non-deductible principal, and $3,000 of earnings in the $8,000 account. We use that pro rata rule. Her basis is $8,000 to 62.5% of the account value. Her earnings are $3,000, $8,000, 37.5%. So her $6,000 withdrawal is 62.5% non-taxable return of principal, $3,750, and 37.5% taxable earnings, $2,250. The material confirms.
$2,250 taxable.
Okay, $2,250 taxable is better than $6,000, but still taxable income. Right. And now, scenario 3, it's a Roth IRA. She takes the $6,000 withdrawal 4 years after contributing, so she's only age 59. This is a non-qualified distribution because she's not 59 and a half yet, and she hasn't met the 5-year rule. But remember the Roth ordering rules. Principal comes out first. Her $8,000 account has $5,000 principal and $3,000 earnings. Her $6,000 withdrawal is considered to be first, her $5,000 in principal. That $5,000 comes out completely tax-free.
Okay.
The remaining $1,000 of the withdrawal, $6,000 total, $5,000 principal, must come from earnings. Since this is a non-qualified distribution, that $1,000 of earnings is taxable. The material confirms $1,000 taxable.
Wow. Only the $1,000 taxable here compared to $6,000 or $2,250 in the traditional scenarios, even though it wasn't a qualified withdrawal. That principal first rule is huge.
It really is. It makes accessing your contributions much easier. Now, scenario 4. Roth IRA, she withdraws 6 years after contributing, so she's age 61. Now she meets both conditions. She's over 59 and a half, and she's met the 5-year rule. 6 years have passed. This is a qualified Roth distribution.
And the tax consequence?
0. The material confirms that with a qualified Roth IRA distribution, neither the principal, $5,000 in her withdrawal, nor the earnings, $1,000 in her withdrawal, are taxed. $0 taxable income.
That's the ultimate goal. Comparing those 4 scenarios really highlights the potential power of the Roth structure, the tax-free qualified distributions, and the flexibility even with non-qualified ones thanks to the ordering rules.
It's a perfect illustration. Understanding these distribution rules is just as vital as knowing the contribution rules.
Okay, let's quickly cover the 10% penalty for early IRA distributions. General rule is the same. 10% extra tax on the taxable portion if you take it out before age 59 and a half. But you said the list of exceptions is slightly different from 401ks.
Yes, the material lists the common IRA penalty exceptions. Using up to $10,000 for a first-time home purchase. Paying for qualified higher education expenses. Paying for health insurance premiums if you've been unemployed for 12 consecutive weeks or more. Paying for medical expenses that exceed a certain percentage of your AGI if you become totally and permanently disabled. Taking distributions as part of a series of substantially equal periodic payments, SEPP, taking up to $5,000 shortly after a qualified birth or adoption, if the distribution is made to your beneficiary after your death or if you are terminally ill, and up to $22,000 for certain federally declared disasters.
Okay, some overlap, some differences. Notably, that age 55 separation from the service rule we talked about for 401k is not on the list for IRAs.
Correct. That's an important distinction between employer plans and IRAs.
And one more really big planning advantage for Roth IRAs compared to traditional IRAs or 401k. No required minimum distributions during the original owner's lifetime.
Explicitly stated in the material. And a key benefit, especially for estate planning or if you don't need the money in retirement. It allows that money to potentially keep growing tax-free for your entire life. You only have to take RMDs from inherited Roth IRAs, generally.
Good point. What about retirement savings options if you're self-employed? The sources touch on these too.
Yes, briefly. For self-employed individuals or small business owners, there are plans like SEP IRAs, simple IRAs, and solo 401ks. Generally, contributions you make for yourself to these plans are deductible as an above-the-line adjustment to your AGI, similar to a deductible traditional IRA contribution, but often with much higher limits.
And the rest is similar. Tax-deferred growth, distributions, taxes, ordinary income.
Pretty much. Earnings grow tax-deferred, and distributions are typically taxed as ordinary income, subject to the same early withdrawal penalties and RMD rules.
But there was a change mentioned for 2023 allowing a Roth option.
Yes. Starting in 2023, the law changed to allow self-employed plans like SEP and simple IRAs to potentially offer a Roth contribution option, similar to how 401ks can. If offered and chosen, contributions would be non-deductible, made after tax, but qualified distributions would be tax-free. Solo 401ks could already offer a Roth option.
And the contribution limits are generally higher for these self-employed plans.
Yes, significantly higher than standard IRAs. The material lists the 2023 maximums. For SEP IRAs and Solo 401k, the employer, which is effectively you for yourself, could contribute up to 25% of your net adjusted self-employment income, capped at a dollar maximum of $66,000 for 2023. Solo 401ks also allow you to make employee contributions up to the regular 401k limits, $22,000 or $30,000 if 50 plus in 2023, on top of the employer contribution as long as the total doesn't exceed the overall limit, $66,000 or $73,500 if 50 plus. Simple IRAs have lower limits, requiring employee contributions up to $15,500, $19,000 if 50 plus, and a mandatory employer contribution, either a match or a flat percentage.
So potentially much larger contributions possible if you're self-employed. Let's talk about Roth conversions, moving money from a traditional retirement account to a Roth account.
Right. This involves taking funds from a traditional IRA, or sometimes a traditional 401k, and moving them into a Roth IRA or Roth 401k. It can be done via a direct trustee-to-trustee transfer, which is usually recommended.
Or an indirect rollover.
Or an indirect rollover, where you get the money first and have 60 days to deposit it into the Roth account. Again, direct transfer is generally safer and avoids potential pitfalls like the 60-day deadline and mandatory withholding from 401k rollovers.
What's the main tax consequence of doing a Roth conversion?
This is the big one. The material states clearly that the entire amount you convert from the traditional account that hasn't already been taxed, i.e. deductible contributions and all earnings, is treated as taxable ordinary income in the year you do the conversion. You're essentially choosing to pay the income tax on that money now rather than later.
So you need to be prepared for potentially a large tax bill in the year you convert. What about the 10% early withdrawal penalty? Does that apply to conversions?
Generally, no, not on the conversion itself, as long as the money goes directly into the Roth account, either via direct transfer or completing the rollover within 60 days. However, there's a separate 5-year rule that applies to the converted principal amount if you later withdraw it from the Roth IRA before age 59 and a half. Each conversion has its own 5-year clock for penalty purposes on withdrawals of that specific conversion amount.
Okay, that's nuanced. But here's another interesting point from the material. Unlike making direct contributions to a Roth IRA, which have those ANGI limits we discussed, there are no income restrictions or annual limits on doing a Roth conversion.
That's a key strategy, often called the backdoor Roth IRA. If your income is too high to contribute directly to a Roth IRA, you can potentially make a non-deductible contribution to a traditional IRA, since there are no income limits on making non-deductible contributions, and then, shortly after, convert that traditional IRA to a Roth IRA. Since the initial contribution was non-deductible, only any small earnings that accrued before the conversion would be taxable. The material confirms conversions themselves aren't capped by amount or limited by AGI.
A useful workaround for high earners.
Okay.
One last type of account mentioned in the retirement section, annuities. These are insurance contracts, right?
Yes. Fundamentally, they are contracts between you and an insurance company. They are often used for retirement planning because they offer tax-deferred earnings growth, similar to IRAs and 401ks, but they operate differently.
The material mentions two main types, immediate and deferred.
Right. An immediate annuity is pretty straightforward. You give the insurance company a lump sum of money, and they start paying you a regular income stream almost right away, usually within a month or maybe up to a year. There's no real accumulation phase. It's designed for immediate income needs.
And a deferred annuity.
That has two distinct phases. First is the accumulation phase, where you pay premiums, either a lump sum or over time, and the money inside the contract grows tax-deferred. Then later, you enter the payout or distribution phase, where the insurance company starts making regular income payments back to you based on the accumulated value and the payout option you choose.
What are the different kinds of deferred annuities based on how they grow?
The material lists 3 main types. Fixed annuities offer a guaranteed interest rate credited by the insurer. Your return isn't directly tied to market performance, providing safety but potentially lower growth. Variable annuities allow you to invest the premiums in underlying subaccounts, similar to mutual funds, so the value fluctuates based on market performance, higher potential growth, but also market risk. Equity-indexed annuities offer returns linked to the performance of a specific market index, like the S&P 500, often with a guaranteed minimum return, but also caps on the upside potential. The material notes that fixed and equity-indexed annuities are usually general account products of the insurer, meaning they are subject to the claims of the insurer's creditors, whereas variable annuity funds are held in separate accounts, offering more protection from the insurer's potential insolvency.
How are the annuity payments taxed once you start receiving them in the payout phase?
Since your contributions, premiums, were generally made with after-tax dollars, unless funded by a qualified plan rollover, a portion of each payout is considered a tax-free return of your original investment, principal basis, and the rest is considered taxable earnings, taxed as ordinary income. The way the split is calculated depends on whether it's a fixed period payout or a lifetime payout.
Let's take the fixed period annuity first, where you know exactly how many payments you'll receive.
The material uses what's called the annuity exclusion ratio. You calculate the ratio of your total investment, premiums paid, to the total amount you expect to receive over the fixed period. That ratio or percentage is the portion of each payment that is considered a non-taxable return of your principal. The rest is taxable earnings. The formula is original investment expected value, which is payment amount, number of payments.
Okay, let's use example 3, Zoe. She paid $60,000 for an annuity that will pay her $750 per month for exactly 120 months, 10 years.
First, calculate her total expected value. 750 month, 120 months equals $90,000. Now find the exclusion ratio. Her $60,000 investment, $90,000 expected value equals 0.6667 or 66.7%.
So 66.7% of each $750 payment is non-taxable return of her principal.
Correct. 66.7% of $750 is $500.25 per month. That amount is tax-free. The rest of the payment, $750 total, 525 cents non-taxable, equals $249.75 per month, is considered taxable ordinary income. She receives payments this way for the full 120 months until her $60,000 principal is fully recovered.
For a life annuity, you can't calculate the exact expected value, so instead the IRS provides standard life expectancy tables. You take your original investment and divide it by a factor, representing expected months of payments from the IRF table based on your age when the payments begin. This calculation gives you a fixed dollar amount of each payment that is considered a non-taxable return of principal.
Let's use example 4, John. He's 64, paid $60,000 for an annuity, paying $600 per month for life. The IRS table factor for his age is 260 months. Okay. His non-taxable return of principal per month is calculated as $60,000 investment, 260 months IRS factor equals $230.77.
So $230.77 of each $600 payment is tax-free. The rest must be taxable.
Yes. $600 total payment, $230.77, non-taxable return equals $369.23 per month is taxable ordinary income. Now, the material covers what happens if he lives longer or shorter than the 260 months assumed by the IRS factor.
Right.
If John lives longer than 260 months, once he has received that $230.77 tax-free for 260 months, fully recovering his $60,000 investment, any further payments he receives are 100% taxable. If he dies sooner, say after only 250 months, he hasn't recovered his full $60,000 investment tax-free.
Yeah.
The remaining unrecovered investment, $230.77, 10 remaining months equals $2,307.70, can be claimed as a deduction on his final income tax return.
Interesting. So there's a final reckoning depending on longevity. Okay, finally, on retirement planning, the sources offer some guidance on actually choosing the right plan or approach.
Yeah, the absolute first priority recommended, if available, is contributing enough to your employer's 401k to get the full employer match. Always grab that free money first.
Can't argue with that. Beyond the match, a really key decision point seems to be comparing your current marginal income tax rate to what you expect your marginal rate to be in retirement.
That's the classic traditional versus Roth dilemma. The general rule of thumb presented is, if you think your tax rate is higher now than it will be in retirement, a traditional account, getting the tax deduction now when it saves you more, might be better. If you think your tax rate is lower now than it will be in retirement, a Roth account, paying the lower tax now to get tax-free withdrawals later, might be better.
Of course, predicting future tax rates is tricky.
Very tricky, but it's the framework for making the decision. And we also have to remember that unique advantage of Roth IRA's no RMDs during your lifetime, allowing potentially indefinite tax-free growth if you don't need the money.
The material wraps this section with example 5, Paul Smith, which seems to tie a lot of these threads together. Let's break him down. He's 55, single, wants to save $15,000 this year. His employer offers a Roth 401k with a generous dollar-for-dollar match on contributions up to $10,000. His income is too high to contribute directly to a Roth IRA and too high to deduct a traditional IRA contribution because he's covered by the 401k. And crucially, he's currently in a relatively low 21% federal tax bracket, but expects to be in a much higher bracket in retirement.
Okay, lots of factors there. 55 years old, $15K to save, has a Roth 401k option with a great match. High income limits his IRA options. And importantly, low tax rate now, expects high rate later.
So what's the recommended strategy for Paul based on the material?
The optimal path highlighted is for Paul to contribute his entire $15,000 into the Roth 401k. Well, first, he absolutely needs to contribute at least $10,000 to capture that full $10,000 employer match. Since he's contributing to the Roth 401k, remember that the $10,000 match itself, assuming the plan designates it as Roth or even if traditional, will likely be taxable income to him in the year it's contributed, but it's still a 100% return on his first $10 K save.
Okay, get the match. Can he contribute the full $15,000 he wants to save?
Yes. Because he's 55, his individual employee contribution limit to the 401k for 2023 was $30,000, $22,500 base plus $7,500 catch-up. So his desired $15,000 is well within that limit.
So why specifically the Roth 401k for the whole $15,000 instead of traditional?
Because of his tax situation. Low rate, 21% now, expected high rate later. By contributing to the Roth 401k, he pays the income tax on his $15,000 contribution at the low 21% rate now. Then, assuming he meets the requirements, he'll be over 59.5 and the account will be open over 5 years when he retires. All his withdrawals and retirement contributions and earnings will be completely tax-free, even though he'll likely be in a much higher tax bracket then.
What if he chose the traditional 401k instead?
He'd get a tax deduction at his current 21% rate on his $15,000 contribution, which would save him $3,150 in taxes today. Sounds good, right? But then in retirement, when he's in that anticipated higher tax bracket, every dollar he withdraws from the traditional 401k would be taxed at that higher rate. Over the long run, paying the lower 21% tax now is likely much better for him than getting a small deduction now, but paying higher taxes on a potentially much larger amount later.
And the IRA options were non-starters because of his high income.
Right. Can't contribute directly to a Roth IRA due to NGI limits. Can contribute to a traditional IRA, but can't deduct it because his income is too high and he's an active participant in the 401k. Making non-deductible traditional IRA contributions isn't usually ideal because the earnings are still taxed on withdrawal, unlike the Roth. So the Roth 401k hits the sweet spot for Paul.
That example really pulls it all together, considering the match, contribution limits, income limits, tax rates now versus later, and the specific account features.
Exactly. It shows how finding the best strategy really depends on looking at all those pieces for your specific situation.
Okay, that was an incredibly comprehensive look at retirement planning. Let's shift gears now and talk about understanding investments themselves, starting with the concept of investment risks.
Right. Risk. The material defines it pretty simply. The possibility or exposure to loss. And it stresses that the goal isn't necessarily to eliminate all risk that's often impossible in investing, but rather to choose methods that help you avoid catastrophic financial loss.
And there's that fundamental relationship. Generally, if you want the potential for higher returns, you have to accept higher risk, and vice versa. Lower risk usually means lower potential returns.
That's the classic risk-return trade-off. The material breaks down investment risk into two primary types: non-systematic risk and systematic risk.
Okay, non-systematic risk, sometimes called business risk or specific risk. It's unique to a particular company or maybe an industry.
Exactly. And the key takeaway about non-systematic risk is that it is diversifiable. You can significantly reduce your exposure to this type of risk by spreading your investments out, owning stocks or bonds from many different companies across different industries, maybe even different countries.
What are some examples from the material?
They mentioned default risk. That's the risk that a specific company or maybe a city issuing a bond won't be able to make its promised payments. Or management risk, maybe a company makes bad operational decisions or loses a key CEO, hurting its performance. If you own just that one stock or bond, you're fully exposed. But if you own hundreds, the impact of one company failing is much smaller.
Diversification smooths out those company-specific bumps. Now, systematic risk is the other type, also called market risk.
Yes, because this type of risk affects the entire market or the whole economy. Think broad economic downturns, major political events, interest rate changes across the board.
And the crucial difference here is that systematic risk is not effectively mitigated just by diversifying your portfolio across lots of stocks and bonds.
Correct. Owning hundreds of stocks won't necessarily protect you if the entire stock market crashes due to, say, a global recession. Diversification helps with the company-specific stuff, but not the big picture market movements.
Examples of systematic risk given.
The material lists currency risk changes in exchange rates affecting international investments or companies with global sales. Inflation risk, the risk that rising prices erode the purchasing power of your money and the real return on your investments, especially fixed income ones. And sociopolitical risk, large political or social events destabilizing markets or impacting asset prices broadly.
So if diversification doesn't really help much with systematic risk, how do investors try to manage it?
The material briefly touches on more advanced strategies that professional or sophisticated investors might use, like investing in derivatives, options, futures, or using strategies like short selling. These tools are designed to potentially profit or hedge against losses when the overall market goes down, but they are definitely more complex and riskier than simple buy and hold diversification.
Okay, let's look at a couple of the core investment types the sources discuss. First up, equity securities stocks.
Right. When you buy stock, you're buying an ownership interest or equity in a corporation. You become a part owner, a shareholder.
And what rights does that give you?
As a shareholder, you generally have a claim on a portion of the company's assets and profits, often paid out periodically as dividends based on how many shares you own. You might also get voting rights on certain company matters.
And the potential outcomes for stock investing.
It's a wide range. You could lose your entire investment if the company goes bankrupt. But on the flip side, if the company is successful and grows, the potential for profit is theoretically unlimited. High risk, high potential reward.
Next up, the sources cover bonds. These are different.
Very different. A bond is an ownership. It's essentially a loan. When you buy a bond, you are lending money to the issuer, the borrower. You become a creditor, not an owner.
And the terms of that loan are spelled out in a document called the indenture.
Exactly. The indenture lays out all the specifics. The interest rate, called the coupon rate, the borrower will pay you. The maturity date, when they have to repay the principal amount you lent them, called the face value. And any other conditions or covenants.
Who issues bonds?
All sorts of entities borrow money this way. Corporations issue bonds, often instead of getting bank loans. Municipalities, cities, states, counties issue bonds to fund public projects. Even sovereign governments issue bonds to finance their operations.
The material seems to focus on two primary types for comparison.
Yeah.
Corporate bonds and municipal bonds.
Yes. Corporate bonds are issued by companies to raise capital. Pretty straightforward. The key thing to know about the interest you receive from corporate bonds is that it's generally subject to both federal and state income tax. The material also notes that for their purposes, interest from U.S. government bonds, treasuries, is taxed similarly at the federal level, though typically exempt from state tax, which is a nuance not heavily stressed here but important in practice.
And if you borrow money to buy these taxable corporate or treasury bonds, say using margin in a brokerage account,
since the interest income you receive is taxable, the interest expense you pay on the loan used to purchase those bonds is generally tax deductible, subject to investment interest expense limitations.
Okay. Now, municipal bonds, or munis, issued by state and local governments.
Right, typically to fund public projects like building schools, bridges, roads, water systems, things like that.
What are the key differences from corporate bonds, especially regarding taxes?
The biggest difference is the tax treatment of the interest. Interest earned on most municipal bonds is exempt from federal income tax. And it's often also exempt from state and local income taxes if you reside in the state or locality that issued the bond. This triple tax exemption, potentially, makes munis particularly attractive to investors in higher tax brackets because the tax savings can make their effective return higher than a corporate bond with a similar pre-tax yield.
And are they generally considered safer than corporate bonds?
The material suggests they often are, largely because the issuing municipality usually has the power to raise taxes on its residents to ensure it can meet its bond payment obligations. Corporations don't have that power. Of course, municipalities can still default, but it's generally less common than corporate defaults.
What if you borrow money to buy municipal bonds? How's the interest expense treated then?
It's the opposite of corporate bonds. Because the interest income you receive from the municipal bond is tax-exempt, the interest expense you incur on any loan used to purchase or carry those tax-exempt bonds is not tax-deductible. The tax code generally prevents you from deducting expenses related to generating tax-free income.
That makes sense.
Oh, okay.
That gives us a good grounding in some key investment types and risks. Let's move on to planning for another major financial goal: funding post-secondary education, college, university, etc.
Yeah, a big expense for many families. The material points out that the tax law offers several tax-advantaged ways to save specifically for education. It mentions 529 plans, Coverdell Education Savings Accounts, ESAs, U.S. Series E savings bonds used for education, and even touches briefly on custodial accounts like UGMA, UTMA, although those aren't strictly education accounts.
And it also notes that if these savings vehicles aren't enough, there are other avenues like financial aid, grants, which are essentially free money.
Like Pell Grants and FCOs.
Scholarships, also potentially free money, though, with some tax rules.
And of course, various types of student loans, which importantly must be repaid. Let's dive into the specifics of Section 529 qualified tuition programs, often just called 529 plans. These are sponsored by states or sometimes by eligible educational institutions themselves.
The material describes two main types of 529 plans people might encounter: prepaid tuition plans and educational savings plans.
Right. And both types share some core tax advantages. Any earnings inside the account grow tax deferred. And then if the money is used for qualified education expenses, the distributions are generally free from federal income tax. Some states also offer a state income tax deduction or credit for contributions made to their own state's plan, but that varies quite a bit.
Tell us more about the prepaid tuition plan option first. How does that work?
A prepaid plan is really designed as a hedge against rising tuition costs. You essentially buy units or credits of tuition at today's prices, usually for in-state public colleges and universities. The value of those credits is then guaranteed by the plan, often backed by the state, to keep pace with tuition inflation at those participating schools.
So it sounds like it has lower investment risk compared to investing in the market.
Much lower. The material describes it as a low-risk, tax-advantaged way to save, where your effective earnings basically match the rate of tuition inflation, which historically has often been higher than standard savings account rates. The main risk mentioned is if the student decides not to attend one of the participating in-state schools. You can usually still get the value out to use elsewhere, but it might not cover the full cost of tuition at an out-of-state or private school.
Okay. What about the other type, the educational savings plan?
This is much more like a typical investment account, often compared to a Roth IRA, but specifically for education. You contribute money, and it's invested in various market-based options, usually mutual fund portfolios offered by the plan. There's no guarantee on the return. The account value will fluctuate with market performance.
So the outcome is less certain.
Exactly. Depending on how the investments perform, the account might grow significantly and cover all the costs, or it might underperform and not be sufficient. There's market risk involved. But there's also potential for higher growth than a prepaid plan.
And who owns the money in a 529 savings plan? Is it the student?
No, that's a key point. The assets are owned and controlled by the account owner, who is typically a parent or grandparent. The student is the beneficiary. This means the owner decides how the money is invested and when withdrawals are taken. It also means if the beneficiary doesn't end up needing the funds for education, the owner can change the beneficiary to another eligible family member or potentially withdraw the funds themselves, though non-qualified withdrawals of earnings would be taxable and penalized.
How are these 529 plans typically funded? You mentioned contributions.
Yes, they're usually funded by gifts. Contributions are considered gifts to the beneficiary for gift tax purposes. This means they're subject to the annual gift tax exclusion limit, which was $17,000 per donor per beneficiary in 2023.
But there's a special rule that allows for larger upfront contributions, sometimes called superfunding.
That's right. The law allows you to make a lump sum contribution to a 529 plan and elect to treat it as if it were made evenly over a 5-year period for gift tax purposes. So, using the 2023 limit, an individual could contribute up to $17,000 is $85,000 in 1 year to a beneficiary's 529 plan, using up their annual exclusion for that beneficiary for the current year and the next 4 years.
And if a married couple does this together, using gift splitting,
they could potentially contribute up to $534,000 their combined annual exclusion. It was $170,000 per beneficiary in a single year, front-loading 5 years' worth of exclusions. You just have to file a gift tax return to make the 5-year election, and remember, you can't make additional annual exclusion gifts to that same beneficiary during the rest of that 5-year period.
a powerful way to jumpstart savings. Now, what expenses actually count as qualified higher education expenses, QHEE, that allow for tax-free distributions from a 529 plan?
The material lists the main ones: tuition and mandatory fees, books, supplies, and equipment required for enrollment or attendance at an eligible post-secondary institution, college, university, vocational school, etc. It also includes expenses for room and board, but only for students who are enrolled at least half-time. The amount for room and board is limited generally. It can't exceed the allowance for room and board included in the school's official cost of attendance figures for financial aid purposes. There are also allowances now for K-12 tuition, up to 10 carrier, and student loan repayment, lifetime limit, but the core use is higher ed.
Okay, now let's tackle how distributions are taxed if they happen to exceed the qualified expenses in a given year. This seems like where it can get tricky.
It can. First, remember that the portion of any distribution that represents your original contributions, the principal or basis, is never taxable. That's just getting your own money back. The potential tax issue is with the earnings portion of the distribution.
And earnings only become taxable
If the total amount distributed from the 529 plan during the year is more than the student's adjusted qualified education expenses, or AQE, for that same year.
Okay, what's AQE? Adjusted Qualified Education Expenses.
AQE is defined as the student's total qualified higher education expenses, QHEE, for the year, minus any tax-free educational assistance they received for those same expenses.
Yeah.
Tax-free assistance includes things like Pell Grants and tax-free scholarships.
So you have to subtract the free money first before seeing how much the 529 can cover tax-free.
Exactly. The materials example 6 with Joe really helps illustrate this calculation. Let's run through it. Joe's parents contributed $20,000 to his 529 over the years. It grew to $30,000, so that's $20K principal and $10K earnings. In his first year of college, Joe had $9,000 in total QHE, tuition, fees, books. He also received a $6,000 tax-free scholarship. He took a $5,000 distribution from his 529 plan.
Okay, first step is to calculate his AQE.
Right. His total QHE was $9,000. Subtract the $6,000 tax-free scholarship, so his adjusted qualified education expenses, AQE, for the year are $3,000.
Now compare his total distribution, $5,000, to his AQE, $3,000. Since the distribution is larger than the AQE, we know that part of the earnings he took out must be taxable.
Precisely. Now we need to figure out how much. The logic is only the portion of the earnings related to the amount needed for AQEE is tax-free. The earnings related to the excess distribution are taxable. The material shows the calculation. You figure out what percentage of the total distribution was used for AQE. In Joe's case, $3,000 AQE, $5,000 total distribution equals 0.60 or 60%.
Okay, 60%.
That means 60% of the earnings portion of his distribution is tax-free. We need to know how much of his $5,000 distribution was earnings. Since his account was 13 earnings, $10 earnings, $30K total value, his $5,000 distribution included $5,000, 13, equates $1,667 in earnings, approximately. So 60% of those earnings are tax-free. $1,667 must be taxable. Yes. Total earnings distributed were $1,667. Tax-free portion was $1,000. So $1,667, approximately, the example seems to round slightly differently, maybe based on precise ratio, showing $400 taxable. Let's use the example's result for consistency. The example calculation might use the overall ratio. Taxable earnings, each in class. Total earnings and distribution, AQE, total distribution. So $1,667, $5,000, $3,000, $5,000, $1,667, $2,000, $5,000, $4,140, $667 taxable. The example text says $400 taxable. Let me reread the example calculation provided in the outline. It calculates the tax-exempt earnings differently. Tax-exempt earnings, AQE, total distribution. I can't be right. Let's use the logic. The total distribution is $5K. $3 is needed for AQE, $2 is its excess. The distribution is $20K principal, $10 earnings. The account is $20K principal, $10 earnings. $30K total, so $23 principal, $13 earnings. The $5K distribution is $3,333 principal tax-free and $1,667 earnings tax-free. The remaining $2K distribution, $5K, $3K, is the excess, composed of $2.23 equals $1,333 principal tax-free, and $2.13 equals $667 earnings taxable. Okay, the outline explanation seems convoluted, but the logic leads to $667 taxable earnings. Let's stick with that logical breakdown. $667 is taxable ordinary income.
Okay, so the key is that the earnings associated with the portion of the withdrawal not covered by AQE become taxable. That makes sense. Coordination is important.
Absolutely. And on top of the ordinary income tax on those taxable earnings, there's also usually a 10% penalty tax.
Another penalty.
Yes, similar to early withdrawals from retirement accounts. The taxable portion of a non-qualified 529 distribution is generally subject to an additional 10% penalty unless one of a few specific exceptions applies.
What are the exceptions to the 529 penalty?
The material lists exceptions like distributions made because of the beneficiary's deaths or disability, distributions included in income only because the beneficiary received other tax-free aid, like Joe's scholarship situation, or distributions related to the beneficiary attending a U.S. military academy.
Okay, let's move on to Coverdell Education Savings Accounts, or ESAs. Another option.
Right. Coverdell ESAs are separate savings accounts set up for a specific beneficiary's qualified education expenses. Some key rules highlighted in the material. Contributions are non-deductible, made with after-tax money. There's a relatively low maximum contribution limit of $2,000 per beneficiary per year combined from all contributors. So if grandma contributes $1,500, mom and dad can only contribute $500 total for that child that year.
And the beneficiary usually has to be under 18.
Yes, generally the beneficiary must be under age 18 when the account is established, although there's an exception for beneficiaries with special needs. You can set up multiple accounts for multiple beneficiaries, though.
Are there income limits for contributing to a Coverdell ESA?
Yes, similar to Roth IRAs, your ability to contribute is phased out based on your modified AGI, MGI. For 2023, the phase-out range for single filers was $95,000 to $110,000 MAGI, and for married filing jointly, it was $190,000 to $220,000 MEGI. Above those limits, you can't contribute.
How do the earnings and distributions work?
Earnings accumulate tax-free inside the Coverdell ESA. Distributions, including both the contributions and the earnings, are tax-free as long as they're used for qualified education expenses. If the total distributions in a year exceed the qualified expenses, then the earnings portion of that excess amount is taxable income to the beneficiary.
What counts as qualified education expenses for a Coverdell? Is it the same as a 529?
It's actually broader, according to the material. It includes the usual tuition, fees, books, supplies, equipment, and room and board for post-secondary education. But it also includes these expenses for elementary and secondary school, K-12, and it can cover things like tutoring.
K-12 expenses, too. That's a key difference. Is there an age limit for using the Coverdell funds?
Yes, there's an age 30 rule. The money in a Coverdell ESA must generally be distributed by the time the beneficiary reaches age 30. If it's distributed to the beneficiary, then the earnings portion is taxable and subject to the 10% penalty. However, the funds can be rolled over tax-free and penalty-free to another eligible family member's Coverdell ESA before age 30. The age 30 limit doesn't apply if the beneficiary has special needs.
Can you use Coverdell funds and also claim education tax credits, like the American Opportunity Credit?
Yes, the material says you can claim credits and take tax-free Coverdell distributions in the same year, but you cannot use the exact same expenses to justify both benefits. You have to allocate the expenses between the credit and the tax-free distribution.
Okay. Another savings vehicle mentioned is U.S. Series E savings bonds. How can they help with education costs?
The interest earned on Series E bonds can be excluded from federal income tax if certain conditions are met. The bonds must have been issued after 1989. The owner must be at least 24 years old when the bonds are issued. And the bond proceeds, principal and interest, must be used to pay for qualified higher education expenses for the taxpayer, their spouse, or their dependents.
And what are qualified expenses here?
It's primarily tuition and mandatory fees at an eligible institution. Importantly, you have to reduce your qualified expenses by any tax-free assistance received, scholarships, grants, etc., before determining how much EE bond interest can be excluded. The material also notes that making contributions to a 529 plan or a Coverdell ESA counts as a qualified expense for the purpose of excluding E-bond interest.
Is this tax exclusion available to everyone regardless of income?
No, like many education benefits, it's phased out based on the bond owner's modified AGI, MGI, in the year the bonds are redeemed and used for education. For 2023, the interest exclusion started to phase out for single filers with MGI between $91,850 and $106,850, and for married filing jointly between $137,800 and $167,800. If your MGI was above those upper limits, none of the EI bond interest is tax exempt, even if used for qualified education expenses.
Okay, switching from saving to borrowing, student loans. A major reality for many.
Absolutely. And the material makes a critical point up front. Unlike grants or scholarships, loans must be repaid. Planning for repayment is essential. Federal student loans generally have to be repaid even if the student doesn't finish their degree, although there are specific programs for forgiveness, cancellation, or discharge in certain situations, like disability, school closure, public service, etc.
The sources detail federal Stafford loans first.
Stafford loans are common federal loans for undergraduate and graduate students. Eligibility often depends on demonstrating financial need, which is calculated based on the cost of attendance minus expected family contribution and other aid. They're made by the U.S. Department of Education and usually offer flexible repayment options. There are two types, subsidized and unsubsidized.
What's the crucial difference between subsidized and unsubsidized?
The interest treatment while the student is in school. Subsidized Stafford loans are strictly need-based. The big benefit is that the federal government pays the interest that accrues while the student is enrolled at least half-time, during the 6-month grace period after leaving school, and during authorized periods of deferment. For unsubsidized Stafford loans, which are not need-based, the student is responsible for paying all the interest that accumulates from the day the loan is disbursed, including while they're in school, during the grace period, and during deferment, unless they choose to pay it as it accrues.
So that interest can really add up on unsubsidized loans if you don't pay it during school. A student might get one or both types, depending on their need. What about PLUS loans?
Federal PLUS loans are different. They're available to two groups: parents of dependent undergraduate students, parent PLUS loans, and graduate or professional students themselves, grad PLUS loans. The material seems to focus on the parent PLUS loan. Parents can borrow up to the full cost of attendance minus any other financial aid the student receives. Importantly, PLUS loans are credit-based, not need-based. Eligibility depends more on the borrower's credit history. And for a parent PLUS loan, the parent is the borrower and is legally responsible for repayment, not the student.
Is there any tax break for paying back all this student loan debt?
Yes, there is a deduction for student loan interest paid. You can potentially deduct the amount of interest you paid during the year on qualified student loans, up to a maximum of $2,500 per tax return per year.
Is it an itemized deduction?
No, it's actually better. It's an above-the-line deduction or an adjustment to income. This means you can take it even if you don't itemize, and it directly reduces your adjusted gross income, AGI.
Does the $2,500 limit apply to everyone?
The $2,500 is the maximum deduction. The ability to take the deduction is phased out based on your MGI. For 2023, the deduction started to phase out for single filers with MGI between $75,000 and $90,000, and for married filing jointly between $155,000 and $185,000. If your MGI was above those upper limits, you couldn't take the deduction at all.
Who is eligible to claim this deduction? Are there specific rules?
Yes, the material lists several requirements. You cannot be claimed as a dependent on someone else's tax return. You must be legally obligated to pay the interest on the loan. This is key. For example, if a student is legally responsible for the loan but their parent makes the payments, the student can generally take the deduction, assuming they meet the other criteria, not the parent. The loan must have been taken out solely to pay for qualified education expenses. And if you are married, you must file a joint return to claim the deduction.
Okay, that clarifies the deduction. Now let's quickly cover the free money sources mentioned. Grants.
Right. Grants are financial aid that, crucially, does not have to be repaid. Two main federal grants are discussed. The federal Pell Grant, which is awarded based strictly on financial need to undergraduate students who haven't earned a bachelor's or professional degree yet. The amount varies depending on need, cost of attendance, and enrollment status, full-time or part-time.
And the Federal Supplemental Educational Opportunity Grant, or FCUB.
FCOG is also need-based, but it's targeted towards undergraduate students with exceptional financial need, typically those with the lowest expected family contributions. It's administered directly by the college's financial aid office, so it's called a campus-based program. Not all schools participate. Schools receive a certain amount of federal funds and must contribute some of their own funds as well, a 25% match. Like Pell Grants, FCO funds do not need to be repaid.
And finally, scholarships and fellowships. How are they taxed?
The tax treatment depends on what the funds are used for. According to the material, scholarship or fellowship funds are tax-exempt only if the student is pursuing a degree at an eligible institution. The funds are not considered payment for services, like teaching or research, with some exceptions for required activities, and the funds are spent on qualified education expenses.
What counts as qualified expenses for tax-free scholarship purposes? Is it the same as 529s?
It's actually narrower here, according to the material. For scholarship funds to be tax-free, qualified expenses generally only include tuition and mandatory fees, plus required books, supplies, and equipment. Any portion of a scholarship or fellowship used to cover other costs, like room and board or travel, is generally considered taxable income to the student.
So a full-ride scholarship covering tuition, fees, room, and board would result in the room and board portion being taxable.
That's typically how it works, yes?
What about tuition reductions offered by educational institutions, often to employees and their families?
The material says that for undergraduate studies, a tuition reduction is generally tax-exempt if it's provided to a current or retired employee or their spouse or dependent child by the institution they work for or worked for. For graduate students who are teaching or research assistants, a tuition reduction is generally taxable if it's considered their only form of compensation. However, if the tuition reduction is provided in addition to other taxable salary or wages for their services, then the tuition reduction itself is often not taxed.
Okay, that covers the education funding landscape pretty thoroughly.
Mm-hmm.
Let's pivot now to insurance and its role in mitigating financial risks.
Right. Insurance fits into the broader picture of risk management. The material defines risk, again, as a condition involving the possibility or exposure to loss. And the objective isn't necessarily to eliminate risk, but to choose methods to address it effectively, specifically to avoid catastrophic financial loss.
The sources outline 4 primary methods for controlling or managing risk: avoidance, reduction, retention, and transfer.
Let's break those down. Avoidance is pretty straightforward. You remove the source of the risk entirely. The material suggests this is most appropriate for risks that have both a high frequency, likely to happen often, and high severity, big potential loss. Examples given: choosing to rent a beach house instead of buying one to avoid the risks of storm damage, high maintenance, etc., or using a community pool instead of installing your own to avoid the significant liability risk associated with pool ownership.
Okay, so avoid the activity or ownership. What about reduction?
Risk reduction involves taking steps to lessen the severity or impact of a potential loss if it does occur, rather than preventing the risk itself. This is often used for risks that might happen frequently but tend to have low severity. Examples include installing fire sprinklers. They won't prevent a fire, but they can significantly reduce the damage, or having a home security system to deter burglars and reduce potential theft losses.
Then there's retention. This means you just accept the risk.
Essentially, yes. You consciously decide to absorb the potential cost of the loss yourself, rather than insuring against it. This strategy makes the most sense for risks that are both low frequency, unlikely to happen, and low severity. Won't cost much if they do. You don't pay for insurance. You just plan to pay for any minor issues out of pocket. Large companies might use self-insurance for predictable, smaller claims.
And finally, transfer. Shifting the risk to someone else.
This is where insurance comes in most commonly for individuals. You transfer the financial risk of a potentially large loss to an insurance company by paying them a premium. This is the go-to strategy for risks that are low frequency but high severity, things that probably won't happen but would be financially devastating if they did, like a major house fire or a large liability lawsuit. Other examples of risk transfer mentioned include hold harmless clauses in contracts or incorporating a business to limit the owner's personal liability.
The material includes a helpful little matrix graphic showing this, right? High frequency, high severity leads to avoidance. High frequency, low severity to reduction. Low frequency, low severity to retention. And low frequency, high severity, that's where you transfer risk, often through insurance.
Exactly. It's a good framework for thinking about how to approach different types of risks.
Let's look at some specific types of insurance the sources discuss. First, life insurance.
Life insurance is designed specifically to protect against the economic loss caused by someone's death, what the material calls mortality risk. The payout, the death benefit, can provide income for dependents, pay off debts like a mortgage, cover final expenses and funeral costs, maybe even fund future goals like college for the kids.
Getting life insurance involves insurability, right, an underwriting process.
Yes, the insurance company assesses your health, lifestyle, and other factors to determine if they will offer you coverage and at what price. Premium. The material focuses on 2 main categories of life insurance: term life and permanent life.
Term life is often compared to renting an apartment.
That's a good analogy. Term life provides coverage for a specific, limited period, the term, which might be 10, 20, or 30 years. If the insured person dies during that term, the policy pays the death benefit to the beneficiaries. If the insured person outlives the term, the coverage simply ends.
And then getting new coverage would be much more expensive because you're older.
Exactly. Or potentially unaffordable or unavailable if health has declined. Term insurance is generally most appropriate when the need for coverage is temporary, like covering the years until children are independent or until a mortgage is paid off, especially when funds for premiums are limited, as term is usually much cheaper than permanent insurance initially.
Okay. The alternative is permanent life insurance.
Right.
This is more like owning a home.
Right. Permanent life insurance is designed to provide coverage for the insured's entire lifetime, as long as the premiums are paid. It doesn't expire after a set term.
And a key feature is that it builds cash value.
Yes. A portion of the premiums paid, plus potential investment earnings or dividends, depending on the policy type, like whole life, accumulates inside the policy on a tax-deferred basis. This cash value grows over time.
Can you access that cash value while you're still alive?
Yes, the material mentions a couple of ways. You can typically take withdrawals from the cash value. Withdrawals up to the total amount of premiums you've paid, your basis, are generally received income tax-free, based on a first in, first out FIFO accounting. You can also take loans against the cash value, using it as collateral. Policy loans aren't usually considered taxable income, but interest accrues on the loan, and any outstanding loan balance plus accrued interest will reduce the death benefit paid out eventually.
The sources mention permanent life insurance can be particularly important for high net worth individuals. Why is that?
Often it's for estate planning purposes. The death benefit from a life insurance policy is generally received income tax-free by the beneficiaries. For wealthy individuals facing potentially large estate tax bills, having a large life insurance policy, perhaps owned by an irrevocable trust outside their estate, can provide the necessary liquid cash to pay those estate taxes without forcing the heirs to sell off other assets, like a family business or real estate, often at fire sale prices.
A way to preserve the estate for heirs. Got it. Another type of insurance discussed is long-term care, LTC insurance. This covers costs that your regular health insurance usually won't touch.
Exactly. LTC insurance provides benefits if you need help with daily living activities over an extended period due to chronic illness, disability, or cognitive impairment like Alzheimer's. The trigger for benefits is usually being unable to perform a certain number of activities of daily living, ADLs, without assistance, or having a significant cognitive impairment.
What are those activities of daily living, the ADLs?
The material lists the standard six: eating, bathing, dressing, toileting, getting off the toilet, transferring, like moving from a bed to a chair or wheelchair, and continence, maintaining control of bowel or bladder.
So if you become unable to do, say, two of those six ADLs on your own, or if you have cognitive issues requiring supervision, that typically triggers the LTC policy benefits.
Yes, those are the common triggers, often defined based on IPO standards. The policy then typically pays a preset daily or monthly amount that can be used for various long-term care services, whether it's in-home care, assisted living, or a nursing home.
And the material emphasizes that regular health insurance, whether it's through work or individual, generally excludes coverage for these types of custodial long-term care costs.
That's a critical point. Health insurance covers medical treatments, hospital stays, doctor visits. It doesn't typically cover ongoing help with bathing, dressing, eating because of a chronic condition.
Doesn't Medicare provide some long-term care benefit?
It provides some, but the sources strongly emphasize that Medicare's coverage for long-term care is very limited and often inadequate for people with chronic conditions needing extended care. LTC insurance is described as basically picking up where Medicare leaves off.
What are the key limitations of Medicare's coverage for skilled nursing facility care, according to the material?
To even qualify for Medicare coverage in a skilled nursing facility under Part A, you generally need to require skilled nursing care, not just custodial care, have had a prior qualifying hospital stay of at least 3 consecutive days, be admitted to the skilled facility shortly after, usually within 30 days, the hospital stay, need the care for the condition treated in the hospital, and have a doctor certify the need.
And even if you meet all that, the coverage duration is limited.
Very limited. Medicare pays 100% of approved costs for only the first 20 days in a benefit period. For days 21 through 100, the patient is responsible for a significant daily coinsurance payment. It was over $200 per day in 2023. After day 100 in a benefit period, Medicare pays nothing.
And perhaps the biggest limitation for many needing long-term care.
The material points out a crucial exclusion. Medicare's skilled nursing benefit generally requires that the patient's condition is expected to improve within a predictable time frame. This effectively excludes coverage for many chronic conditions that cause people to need long-term care, most notably Alzheimer's disease and other forms of dementia, for which there is currently no known cure or expectation of improvement.
So that's why cognitive impairment is a separate trigger for LTC insurance benefits alongside the ADLs.
Exactly. HIPAA defines a chronically ill individual who would trigger LTC benefits as someone unable to perform at least 2 ADLs for an expected period of at least 90 days, or someone requiring substantial supervision due to severe cognitive impairment, like Alzheimer's. LTC insurance is designed to cover these situations that Medicare largely doesn't.
Okay. Lastly, umbrella contracts, or umbrella liability insurance. This provides an extra layer of protection against lawsuits.
Yes, specifically for liability claim situations where you are found legally responsible for causing bodily injury or property damage to someone else. It does not cover damage to your own property or injuries to yourself. It's about protecting your assets if you're sued by a third party.
How does it work with your other insurance policies, like homeowners or auto?
The material explains that an umbrella policy requires you to first have certain minimum amounts of underlying liability coverage on your primary policies. EAG, your auto policy might need 250K $500 bodily injury liability, and your homeowners might need 300K or $500K liability. The umbrella policy then provides additional liability coverage above those underlying limits. It only kicks in to pay after the limits of your homeowners or auto policy have been completely exhausted by a claim. It sits like an umbrella over your existing policies, providing an extra $1 million or more in coverage for catastrophic liability events.
So it protects you from those really large, potentially financially ruinous lawsuits that could exceed your standard policy limits. What kinds of things are typically excluded from coverage under a personal umbrella policy?
The material lists some key exclusions. Personal injury to you or damage to your own property, that's what your health, disability, homeowners, or auto physical damage coverage is for. Intentional acts or criminal behavior, if you intentionally injure someone or damage their property, the umbrella policy won't cover the liability. And generally, liability arising from business activities is excluded. This includes things like acting as a director or officer of a company, liability related to your profession, malpractice, or workers' compensation obligations. You typically need separate business liability insurance for those risks. Personal umbrella is for non-business liability.
That gives a clear picture of insurance's role. Okay, let's shift to our second to last major topic, figuring what your investment returns really look like after taxes bite.
Yes, calculating your after-tax rate of return, ATRR. The material first mentions the basic return on investment, or ROI. That's a fundamental calculation, sales price cost. Costs. Simple comparison of gain or loss to the initial investment.
Easy enough, but it has limitations, right?
Exactly. The basic ROI calculation doesn't consider how long you held the investment, and more importantly for this discussion, it completely ignores the impact of taxes. That's why the material emphasizes calculating the ATRR.
The after-tax rate of return shows you what percentage you actually keep in your pocket after income taxes are paid.
Right. It's a much more accurate measure of your true investment performance, especially when comparing different types of investments that might be taxed differently. The basic formula given is ATRR equals ROI, one tax rate.
The material provides example 7 with Alice Peters to make this concrete. Let's see. Alice and her spouse have high income, over $500. They face a 35% federal income tax rate, a 6% state income tax rate, and also the 3.8% net investment income tax, NIT, which applies to investment income for higher earners. They're considering a risky real estate investment. Cost is $100,000. Potential sales price is $125,000.
Okay. Step 1 is to calculate the basic pre-tax ROI. The potential gain is $125,000 sale price, $100,000 cost equals $25,000. The ROI is the gain divided by the cost. $25,000, $100,000 equals 0.25 or 25%. Looks pretty good on the surface.
Step 2, figure out the total tax rate that would apply to that $25,000 gain.
We just add up all the applicable rates, 35% federal plus 6% state plus 3.8% NIIT equals 44.8%, so nearly 45% of their profit would go to taxes.
Plugging in the number ATRR, 125 ROI, 1.448 tax rate. That's 0.250.552.
Which comes out to 0.138 or 13.8%. So their actual return on this investment after accounting for taxes is only 13.8%. That's significantly less than the 25% pre-tax ROI they might have initially focused on. This example powerfully demonstrates why you always need to factor in taxes when evaluating investments. The tax impact can dramatically change the attractiveness of an opportunity, especially for those in higher tax brackets.
A really important perspective.
Okay.
Okay, our final section, planning for estates and their beneficiaries, making sure your assets go where you intend them to go after you're gone.
Yes, and the material stresses the critical importance of how assets are legally owned and whether they have beneficiary designations. A major theme here is understanding and potentially avoiding probate.
We mentioned probate earlier, that formal court-supervised process for settling an estate. It can be time-consuming, public, and expensive, with fees for attorneys, executors, accountants potentially eating into the inheritance.
Exactly. Now, wills are absolutely essential documents. They state your wishes for who gets what. But here's a point the material emphasizes that often surprises people. Beneficiary designations on specific assets generally override whatever your will says about that asset.
Wait, say that again? The beneficiary form beats the will. So if my will leaves everything equally to my 3 kids, But years ago, I named only my oldest child as the beneficiary of my large IRA. The oldest child gets the entire IRA, and the will doesn't matter for that specific account.
That's precisely what the material indicates and how it generally works in practice. Assets that have a designated beneficiary pass directly to that named person, or people, or trust, by operation of contract law, completely bypassing the probate process and the instructions in the will regarding that specific asset.
Wow. What kinds of assets typically have beneficiary designations?
Life insurance policies are a classic example. Retirement accounts like 401k, IRAs, 403bs, annuities, and increasingly you can add beneficiaries to regular bank accounts, payable on death or POD, and brokerage accounts, transfer on death or TOD.
So keeping those designations up to date is incredibly important.
Absolutely critical. The material defines your overall estate as everything you own at death, but the probate estate is only the subset of assets that don't have another way to transfer automatically and therefore must go through the court process guided by your will or state law if you have no will.
And assets excluded from probate, the ones that transfer automatically include.
Assets with those beneficiary designations we just talked about, assets designated payable on death, POD, or transfer on death, TOD, assets owned jointly with right of survivorship, JTRS, and assets properly titled in the name of a living trust during your lifetime.
So the goal of many estate planning strategies is to minimize what's in the probate estate, allowing assets to transfer more quickly, privately, and potentially less expensively to the intended recipients. The strategies listed are using trusts, POD, TOD, keeping beneficiary designations current, and using joint titling appropriately.
Let's touch on those. A living trust, or revocable living trust, is a legal entity you create during your lifetime. You transfer ownership of your assets, house, bank accounts, investments into the name of the trust. You typically act as the trustee while you're alive, managing the assets just like before. The trust document names a successor trustee and specifies exactly how the assets should be distributed after your death.
And the key benefit is probate avoidance.
Yes, because the trust, not you personally, owns the assets at your death. Those assets do not need to go through probate. The successor trustee simply follows the instructions in the trust document to distribute the assets.
But you have to actually do the work of retitling the assets into the trust's name.
Crucial step. If you create a trust but don't fund it by retitling assets, it doesn't do much good. The material does note, however, that retirement accounts, like IRAs and 401ks, generally should not be retitled into a living trust due to potential negative tax consequences. You use beneficiary designations for those instead. But most other assets, real estate, bank accounts, non-retirement investment accounts, are commonly placed in trusts.
Okay, what about those automatic transfer designations? Payable on death, POD, and transfer on death, TOD.
These are simpler tools for specific types of assets. You essentially just fill out a form provided by the financial institution or relevant authority. POD is typically used for bank accounts, savings accounts, CDs. TOD is commonly used for brokerage accounts, stocks, bonds, mutual funds, and in some states, even for real estate deeds or vehicle titles. You name a beneficiary, and upon your death, that asset transfers directly to them, bypassing probate. You can usually name primary and contingent beneficiaries and specify percentages if there are multiple beneficiaries.
Beneficiary designations are highlighted again as a core strategy.
Yes, because they are so effective for the assets that allow them. Life insurance, retirement plans, annuities, POD, TOD accounts, they give you direct control, override the will for that asset, and avoid probate. Keeping them reviewed and updated after major life events, marriage, divorce, birth, death, is paramount.
And the last probate avoidance tool mentioned is joint tenancy with right of survivorship, JTRS.
This is a form of co-ownership, where two or more people own property together. The defining characteristic is the right of survivorship. When one joint owner dies, their share of the property automatically, by operation of law, passes directly to the surviving joint owner.
So the deceased owner's share doesn't go through their will or probate.
Correct. It bypasses probate and belongs immediately to the surviving joint tenants. This is common for married couples owning a home or bank account together. However, using JTROS can sometimes have unintended consequences, especially with non-spouses, like adding a child as a joint owner on an account, so it should be used thoughtfully as part of an overall estate plan.
We have certainly covered a massive amount of ground in this deep dive, really pulling from all that source material you provided. We've dug into the details of retirement savings plans, 401ks, traditional IRAs, Roth IRAs. There are different contribution rules, distribution taxes, penalties, the self-employed options, annuities.
We looked at understanding investment risks, The difference between non-systematic risk you can diversify away and systematic risk you generally can't, and the basics of stocks and bonds, including that key tax difference between corporate and municipal bonds.
Then we navigated the maze of funding education, 529 plans, prepaid versus savings, contribution rules, qualified expenses, taxation, covered ESAs with their unique features, using e-savings bonds,
Hmm.
plus the different types of student loans and grants, and how scholarships are taxed.
And we covered risk mitigation through insurance, the different strategies like avoidance, reduction, retention, transfer, and looked specifically at life insurance, term versus perm, cash value, long-term care insurance, why it's needed, how it works, Medicare limitations, and umbrella liability policies for extra protection.
We also saw how crucial it is to calculate your real return on investment after taxes, using that ATRR formula, because tax can take such a huge bite.
And finally, we touched on those fundamental estate planning tools: wills, trusts, POD, TOD, beneficiary designations, joint tenancy, emphasizing just how powerful and important keeping those beneficiary forms updated really is, as they often trump the will.
So hopefully, you now have a much clearer map of these core personal finance landscapes, grounded right in the specifics from the source material we explored together. We really aim to pull out the crucial insights and the practical implications for you.
Absolutely. It's a lot to take in, but these concepts really form the foundation of sound financial planning.
So maybe a final thought for you to consider as you process all this. Think about the interplay between decisions you make today and outcomes far in the future. How does choosing traditional versus Roth now, based on a guess about future tax rates, interact with the uncertainty of how long you might live, which impacts annuity payouts, or how long your Roth IRA might grow tax-free without RMDs?
Or consider how seemingly simple administrative tasks like retitling an asset into a trust or double-checking the beneficiary you named on an old 401k years ago can have such profound consequences, potentially overriding your carefully drafted will and dramatically affecting who receives your assets and how smoothly that happens. It really highlights that personal finance isn't just about numbers. It's about planning, understanding the rules, and staying engaged over your lifetime.